Hey traders, in this video in the candlestick school series, we're going to look at the 3-line strike. Very rare pattern, very rare candlestick pattern, but a good, powerful one. Stay tuned. Hey traders and investors, a very warm welcome to you. Okay, so 3-line strike, man, this one is powerful. And normally when I do these, I think in my mind, hey, what was a pattern that came up? And I can go straight to it and I can give you guys an example. I've normally got an idea when a reversal happened and of some of the candlestick patterns that I've traded. But this one is so rare, I've scoured through, and only after a lot of scouring have I found them. These are very, very unlikely to see, but you can see why they're so powerful when they do happen. Now, because they're so rare, the idea is you're going to have to be a little bit flexible with the criteria for it. And you'll see in a minute why it's so powerful, and you'll see why it happens so infrequently. But if we're a little bit flexible, we can get a few more signals. So the idea of this 3-line strike is this. We have a sell or a down day, we have another down day, we have 3 kind of red candles. And then on the 4th day, some people will say, technically speaking, you have to have a gap lower. And in real world, you know, it doesn't matter so much. Again, this is a bit of flexibility, but the general idea is on the 4th day, you take out the high of the prior 3 days with a bullish candlestick. That's your 3-line strike. In other words, you've got 3 downtrends or 3 days of downtrend, and on the 4th does all of that and closes or takes out, at least takes out the prior 3 highs. Now, we can tighten this right up and say we must open below, we must close above, we must engulf 3 days. But I'm telling you, the chances of seeing those are so slim because you've got so many things that need to happen. So let's loosen the criteria a little bit. Let's say, okay, as long as we take out the high in some form or another, and let's say we take out the close of this low, let's say we take out the body only, at least, then that's good enough. Or we close, you know, you can see how you can make it a little bit more flexible. So I've got an example here for you on Brown Forman Class B shares. Daily chart, this works well on a daily. Now you're going to see, we'll go look on time frames in a second, but as you go to a lower time frame, you're going to see it far more frequently, but it's less effective. Because obviously on a lower time frame, you could sit for 5 minutes, 15 minutes doing nothing, then all of a sudden, you know, something comes out, volatility changes. Is that a good entry point? It's not bad, but it's nowhere near as powerful as the daily. So you get more signals on a shorter time frame, but they're less powerful. Okay, so let's have a look at this chart. As I say, we've got one here. This is not the absolute textbook example of gapping lower, but in my eyes, it ticks the boxes that you need. You've got to have a little bit of flexibility, like I say with this 3-line strike, because having it, you know, perfect is rare. If you do get it, great. You're on it. But let's have a look at it here. So we'll zoom in and we'll see. We've got day 1 here, day 2, day 3, day 4. Then opens below the close of day 3. It doesn't open below the low, which would be perfect, but it's good enough, right? It's a gap lower, so it's 1 day, 2 days, 3 days of down move, and then on the 4th day, gap lower, exciting the bears. Bulls, however, step in, and not only do they take out the high of the prior day, not only they take out the high of the prior day before that, they also take out the close of the day before that. Now you can see in a perfect world, we would love to see a close above the high. Intraday, it does take out that first day high, which is what we need. But if it closed above it, even better. But in other words, this has kind of taken over 3 days worth of range almost, excluding that little low on day 3. Again, flexibility. But what is the point of it? It's a bullish reversal pattern. After we see 3 down days, we see this supply demand imbalance shift quite significantly. We're looking to go long. So how do we enter the trade? We enter the trade, we go long on the close of day 4, or we go long on a break of the high of day 4 on day 5, if that makes sense. So the high of that trigger bar, we wait for it, we put on a kind of limit or stop limit long, a few ticks above that high, and we're in. Stop losses are going to be the low of the trigger bar. Pretty simple, low minus maybe 1/10 of the range or 1/10 of the ATR or something, just a little bit below there. Don't want it right on the low. Normal rules apply, guys. You know, not right on the low, just below it. The idea being that if it undoes it and comes back, the trade is negated. So in this example, you can see, you know, if we went long at the close at 27.77, the low was 26.64, about $1 or so. You know, we've got a reasonable risk reward ratio. It's not huge, this thing, and I guess if you sat with it and you were working a kind of for a longer term thesis on it, it probably came out alright. And this isn't the most volatile and crazy stock out there. It's probably not one that you'd specifically be watching. You'd say this is a bit too slow, a bit too chuggy, maybe I won't do it. You want ones that are kind of volatile, they're aggressive, and you see that change in sentiment. Can you use it on forex? Yes, you can. Obviously, you're not going to get that gap apart from the Sunday night. Can you use it on indices? Yeah. Can you use it on commodities? Yeah. Just be a little bit more flexible with the rule. I've got one here for you on the Dow. Again, this isn't quite the textbook that we're looking at, but as I say, we are not looking to be textbook perfect here. We're looking to find something that indicates that there's a potential supply-demand imbalance shift, number one, whatever candlestick pattern we're using, and number two, it's got decent probability of success, or number three preferably, it's got a good risk-reward ratio. So if we're taking it, we're getting rewarded for taking the risk. Here's a reasonable one here on the and actually not the Dow, sorry, this is the DAX daily chart, daily candlestick DAX. Takes out 3 days of high. We didn't quite take out the low, so again, this is probably not quite right. We really want to take out the low. We almost did it. It's close enough. It's one of those where if you're very, very strict and you've systemized, you wouldn't be taking it. If you're discretionary, you'd probably allow for that slight red flag, the fact that this thing is so strong and it closed well above the high. Obvious thing here, guys, is that you're buying at the close or you're buying the next day at the open. To me, it's a little bit of a gap, but hey, you know, whatever. And you've got many multiples of your risk. Not many multiples, because that's quite a decent sized candle, but you've got a decent move there before it came back and probably stopped you out. There's something in that. The point is, it's looking for that change in sentiment. So the 3, and then the massive one that comes on day 4, you're in there, you're using it as a clue to say, hey, this day just changed the game. It rotated the round to demand coming in from supply. I want to go long. So time frames, like I say, daily great. You start going low, you start to get more signals, because you know, obviously we have little times when we stagnate in the market, then just kick off. So we had that volatility shift quite a lot in the intraday time frames, like your 3s, your 5s, in your 15s. I mean, if you see on a 15 and 60, I think you're good to go, but just being cautious with it. What else got? So you've got your entries, exits, obviously adjust to how you see the bigger picture. If you've already been looking for a long and a reversal and you see this, maybe you've got 4 or 5 reversal patterns that you look for, and this is one of them, you see this, your target's probably going to be predefined from your initial thesis. And then we've got those examples there when we get, if we take it, how we could potentially get into the trade, and also, you know, where we're going to come out if the thing doesn't work for us. So that is our 3-line strike example, guys. Like I say, very, very, very rare, very uncommon to see on a daily chart specifically, but if you see it, it's worth paying attention for, because it is really giving us an insight. The supply demand imbalance has shifted back in the favor of demand, and we could have a good opportunity for a trade. See you next one, guys. Take care. Bye bye.